All right, all right. Okay. We lost 3 trades. We went 0 for 3. Strict 10% stop loss on every single trade. There was something wrong with the market early on. I had a feeling that it was not really a day to become overly bearish during the beginning hours. And I was correct because the market just continued rising. So it is what it is. I'm standing in front of you as a person who went 0 for 3 after consistently taking a string of disgusting wins. And it is what it is. Not every day is going to be a complete win. It's okay, to lose sometimes because losing is a part of the process. But what's most important is not to allow yourself to be humbled that much. What I mean by that is you need to mitigate your portfolio risk properly. Having small losing trades is irrelevant. If you allocate a large percentage of your portfolio, if you allow your losses to increase dramatically, and if you don't have strict stop losses, that's when you become really, really humbled. And you should never allow yourself to become very, very humbled. Losing is a part of the game. The best shooters in the world, basketball players, soccer players, they're going to miss shots, right? But if you bet your entire house that you're going to make the next 3-point shot and you miss it, obviously that sucks because you risked too much. So what I will say is that in general, right, this is the rule of thumb, you should not put more than 5 to 10% of your entire portfolio into any trade. That's number 1. Number 2 is if you're trading 0 DTE contracts, the maximum loss you should make 15 to 20%. Even that is sort of stretching, but 15 to 20% is usually the max you should be willing to go on a 0 DTE contract. If you think, so say for example, you're going long, right? Say for example, you're going long, contract drops 15, 20%. Sell it for a loss. It's especially when you're first trying to get the hang of trading. And if you've only been trading for X amount of time and you have not been profitable for a large period of time, averaging down is very, very risky. So do not average down. Once you're down 15, 20%, sell it. If you still think the market is going to bounce, re-enter calls at a lower price, but do it with a completely fresh mind, with a fresh position. I hope that makes sense. There is still a lot that we have to talk about. I'm going to mention all that stuff in the Discord. But yeah, I hope, day to day, everything that I'm doing, I don't want to just give advice on, what I think the market is going to do. I want to give more advice on also what people can do better to trade better. And definitely one of the main things is, too large of a portfolio allocation, too loose of a stop loss, and entering at the wrong times. So those are 3 things that you have a lot of control over. And if you can fix those things, it'll drastically improve your decision making. It'll drastically improve the control of your emotions. Because number 1, first of all, we're emotional creatures, right? Humans are emotional creatures. If you allocate too much of your portfolio into a position, you're going to feel a lot more stress with every little small tick. It's your job to mitigate your emotions every single step of the way. So what I mean by that is if you have a smaller position portfolio, it'll allow you to think more logically. That's number 1. Number 2, we're emotional. So having a tight stop loss, you take the emotions out of exiting your trades. So instead of thinking, oh yeah, no, it's going to continue, it's going to bounce, it's going to bounce, it's going to bounce. Instead of doing that, take the emotions out of exiting as well. So my point is that you should try to take the emotions out of every single aspect of trading that you possibly can to allow you to think more logically without emotions, because we are emotional. emotions is one of the biggest reasons why people are not successful traders. Do you understand? So my second point was you have to take the emotion out of exiting the trades. Have a strict stop loss. No matter what you exit at that point, re-enter if you still have the same bias with a completely fresh new trade. And number 3, you should only enter at certain specific points without being swayed or manipulated by price action. So oftentimes, especially these past few weeks, if you try to enter with alongside bullish momentum and you enter long at a level of resistance, oftentimes you could look at the 1 minute chart and you see that it drops. So within a few minutes, your contract would be down 5 to 10%. That would make you very, very stressed. It would make you rethink your position. Then it drops a bit lower, boom, you're down 15% and you're in a losing trade. Had you entered at a better time, at a more logical time, not being swayed or manipulated by price action, then you would not have a potential stop loss hit. So I hope this makes sense. 6.5 minutes. Wow. All right. Well, I hope this helped you guys. Let's get started with the rest of the video. Please make sure to like, comment, subscribe, do all that good stuff if you enjoyed. And yeah, we're going to talk about what happened with the market, how we dropped, and yeah, it's going to be fun. All right, let's get started. Let's make this short and sweet. Don't want to waste anyone's time. The dollar is not telling us anything. The dollar generally gives us a good indication of what's going to happen in the market because it has an inverse relationship to the market. So if the dollar rises, then the market should be falling. The dollar is not telling us anything. The yields are also not telling us anything. It has a the 10-year bond yields have a similar relationship to the dollar, to the market. If the yields are rising, then the market should be falling. We're currently not getting any sort of indication of what's happening with the yields according to the dollar, according to the market. Last but not least, the VIX had obviously a very, very big monumental jump because the VIX is inverse to the market much more closely. If there's volatility in the market and if the market is falling, then the VIX rises. So it also has an inverse relationship. Currently, what we're seeing is the VIX finally closed above 1350. Now we need to see if the VIX can get above 14. If it can comfortably trade above 14 while not being overextended according to the Bollinger Bands, then that could be very, very bearish for the market. But currently, we're still trading below 14 and we are now closed outside of the upper bands. In history, obviously, the VIX can easily continue trading outside of the upper bands for a much longer time. We can continue doing this for days at a time. Multiple times in history, you've seen this. But, you know, we need to have, if we want to sustainably have a move to the downside, then the VIX cannot be trading far outside of the Bollinger Bands comfortably. So with that being said, the dollar and the yields are not giving that much of an indication. The VIX is starting to show some life. We need to see if it can break above 14 and 1450. So there's that for those three. All right, real quick, this is a chart of the S&P 500. We obviously had a big move to the downside, right? But now we're at a level of support. 468 is support on the SPY. We're also at a level of support on the IWM. So immediately, right, it's difficult to just short the whole. Shorting the whole is the equivalent of going long at levels of resistance. You don't do that. You lean short at levels of resistance and you go long at levels of support. So I would be very surprised if we just continue dropping dramatically. But we do have to take into consideration that, you know, the levels of support below are at 464 and 462. If we start to comfortably trade below 466, then that's going to be kind of it's going to be kind of interesting, because yesterday I was saying that if we close below 472, then that would be really, really bearish. We ended up breaking below 472 and then closing at 468. So currently we're at a level of support. Shorting here is not ideal. So let's see if 468 holds. If not, 466. If we start to comfortably trade below 466, if we feel, so here's what we have to look for. During the market hours, if you feel that regular long opportunities are not working properly, and you feel that the market is heavy, right? Just know that it means that there's a lack of buyers. So for today, early in the morning, we felt a lot of strength in the market. So for example, right? Give me one moment. So for example, right? Usual opportunities where we have a big move to the upside. So this is a 1 minute chart of the SPY, right? So usual opportunities where we have a big move to the upside, there should be a bit of a pullback. We didn't get any sort of pullback for multiple legs up. And automatically what that tells me is that there is a lot of buyers. Buyers were in the market all throughout the morning. And basically, when there are a lot of buyers, we're not going to get strong pullbacks for normal market conditions. This is just literally, it was just algorithmic buyers that kept the market up. People throwing their money into the market. And so what I mean is now for tomorrow, right? So now say for example, this is reversed, right? And we have a big giant move to the downside during the market hours. Generally, we should get a nice bounce, right? But similar to this morning, where we had a big move to the upside and we didn't get any bounce or anything at all, right? So if tomorrow we get a big move to the downside with a small bounce, that we should be bouncing much higher, but then we end up making another low, this denotes that there are a lot of sellers in the market and a lack of buyers. So in that instance, right? So in a weak instance like this, normal longing opportunities will not work. And similar, right? When there is a lot of strength in the market, normal shorting opportunities will not work. So all we did earlier on in the morning was we took normal high quality shorting opportunities that would generally work really, really well. They didn't work because there were a lot of buyers. So now what I want to look at for tomorrow is, are there going to be a lack of buyers now? Do buyers feel more comfortable buying at 468? Are they going to stop this freight train of negative momentum to the downside at 468? Or are they going to begin to let the market fall a bit lower, wait for 465, 466 area, try to hold it there, or continue to let it fall and buy it back up between 462, 464? That is yet to be seen. Interested to see how this plays out. But regardless, intraday, anything can happen. So I'm excited to see what ends up happening. The main thing is having enough bullets in the chamber to trade another day. And yeah, man, I hope you guys. Oh yes. Oh, before we even stop, I want to show you guys the IWM. All right. So the IWM is also at a level of support. 196 major support on the IWM. 468 major support on the SPY. And you can see how this is also the gap edge, right the low from the gap. So we need to see if, obviously this is a really important level of support on the IWM. So what I'm saying is we're at a level of support. Generally, levels of support hold. We should get a bit of a bounce, and then from here, that's when the market should end up making a decision for a continued move to the downside or to the upside. But What I'm saying is I would be really, really surprised to see futures open and gap much lower. I'd be very, very surprised because overall seasonality is bullish into the end of the year. And let's see if Santa Claus is coming to town. If not, Santa Claus really just rugged the market and he's going to give everyone calls. So let's see what ends up happening. I hope you guys enjoyed today's video. Please make sure to like, comment, subscribe, do all that good stuff. And I'll see you guys bright and early tomorrow morning on the live stream. All that good stuff. All right. Have a good one.